So my name's Andrew Jack from the Financial Times. Great pleasure to introduce one of the final sessions of the day. Congratulations to all of you who've made it this far. There's some interesting things tonight, actually. Organs, marijuana, arts and music. So there's some fun stuff ahead. But before that, we need the kind of the meat in the sandwich of finance, fundamental, somewhat neglected issue perhaps sometimes. A lot of us interested in policy, but maybe a little less focused on the importance of getting the money to work on that. And so over the next hour, we're going to explore a little bit innovative approaches, conventional approaches, what's missing, what lessons can be learned, how to push things forward. So let me briefly introduce our panel, and what I'll perhaps ask each of you to do initially is just say a couple of words about your organization and your own role, and maybe a couple of exemplary projects where you've been involved to some degree or are planning to be in terms of funding for health-related activities. So let's start with Myshkin Ingawale. So you're from the Interinstitutional Inclusive Innovation Center, is that right?
Yes.
So tell us a little bit more about that.
So this is a non-profit organization which has been set up with 50 different private and public organizations in India, including some large IT companies, some hardware and auto companies, and even universities, sort of with a single ambition of creating an open innovation system where the right ideas, the right people, the right kind of investors, all that can productively collide together, right? So it's sort of based on the experience of a lot of the CEOs within this organization who have gone through a struggle of trying to convince people that what they're doing is worth it, and they have sort of come through that, I guess, alive and doing well. So it's an effort to make a systematic kind of approach, systematic effort to create a thriving ecosystem for early stage ideas in India. And there are many, which I think some of them you might have heard of, both in India and Africa, which are sort of disrupting some industries. Healthcare is one of them.
Mm-hmm. Give us a couple of examples in healthcare. What has been funded so far?
So, closest to my heart is my own company's example. If you, I can tell you my story of failing multiple times in, that will be quite entertaining perhaps. So, so one of the products which I referred to earlier in the conference was a mobile-based urine and blood testing platform. So this is using the phone's camera for imaging of reagent test strips. So up to 25 different kind of medical conditions can be diagnosed with this kind of thing. The funding story of this is interesting, right? Because there isn't any. In the sense that we by this time my company had developed another product previously, had raised investment for that product. But we realized that jumping through hoops in an Excel sheet to prove to people that this will work was not a very efficient use of the core founding team's time. So we just essentially did the funding route was through customers. I don't know if this, sometimes it's possible for some products, for others this might not be feasible. But in our case, funnily enough, there wasn't a single Excel sheet, no PowerPoint. The product was essentially developed by the customers. We took the first version to a few clinics and went with our marker pens and whiteboards with us, this thing. So we gave it to them. They said, no, this we don't like this. They changed it and said that, okay, we can change it, but to make it happen, we had honest kind of dialogue that to make it happen, can you commit to a pre-order of so many devices? So this is the approach we took. It may not always work, but at least in this case, I could tell you this kind of stuff has happened. Mm-hmm. So what I believe is that for many of these potentially disruptive technologies, which could be which I mean, in our case, I know I have studies which show that it's as accurate as the predicate, but it's difficult to convince somebody. I think the first step would be to find, for any kind of new potentially disruptive technology, what is the minimum viable product. It might not even be a product, a minimum viable thingy, which can convince the right people to put their faith in it. Mm-hmm. And in many cases, at least this is a topic which is close to my heart, in many cases, most technologists have this sort of, I have a big idea, it's going to change the world, I just need $5 million or $1 million to make it happen. But instead of that, I think that in many cases, there might be an approach which will enable them to go ahead a little bit more without actually having to jump through hoops to get just professional investors on board.
Right.
That's my.
And this was your personal company, but was the center that you're involved with active in that as well?
So so the center is separate from my company. It's like a collaboration, consortium of these 50 large organizations. What we are trying to do is, I think by and large, many of the entrepreneurs who have made it through the Indian system sort of agree with this, right? That they will not fund ideas. They will fund proven business models, not even proven technologies. Yeah? So in that sense, the whole mission of this nonprofit is to create an open system that transparently showcases both failure and success. Very tangible examples, right? So I was hackathons are something which are open hardware, open software, people coming together and trying to solve big challenges in a collaborative way. This is hackathon kind of thing, which is happening all over the world, including India. So in Bangalore, Hyderabad, in Delhi, now it's fantastic. You get these little pop-ups, at a place where you just sort of unconference way, you gather and then say, here are 5 challenges, let's come together and solve them. So what I foresee the organization I mentioned is trying to do is use some of this, tap into some of this creative energy at places like this, but link it to very strong commercial realities, sort of bake reality into some of the models. So a fantastic example of this was not from I4C, but from an initiative which MIT runs in India. So a professor, some of you might know him, Professor Ramesh Raskar, who teaches at the MIT Media Lab. He's an expert in eye. He has like a whole series of things around engineering the eye and vision. So he came up with a interesting kind of notion that rather than, he has startups of his own which he has got funding for, rather than pursuing in a linear way, as many people do, one company after another, let's open up 20 different ideas to this kind of crowd. So he went to a large eye hospital in India and essentially said, let's do a huge hackathon, right? So he had, and Ramesh, if you're listening somehow, correct me if I'm getting the details wrong, but basically, from my understanding, you had 20 different desks like these, spread out over a big room like this. Each desk had a little problem statement and a small idea, which Ramesh had. Each desk had one surgeon from that hospital standing there. And then you had groups of engineering and design students come there and pick the surgeon's brain on how to sort of make that idea a reality. So for example, how to measure intraocular distance in the most effective, cheapest way for an Indian kind of setting. Or so in our case, it was pathology related. So basically, this kind of approach in a very lean startup way, I think most of us would have gone through that in our own organizations. In a lean sort of way, within a week, created these kind of minimum viable prototypes, if not products, right? Which could then generate enough data to, in a transparent way, showcase whether that approach would have a fighting chance of getting to an actual product. So this process didn't require a lot of money, right? It was time, commitment, it was essentially network. That because of the network of these organizations, it is possible to create this kind of essentially an open data system. Right?
And that's had a lot of take-up, in fact. Some of the Indian businessmen have come in and they've funded these projects.
Exactly. So now some of these projects are getting funded very easily because they can show, they can see it, customers can see it, feel it.
It's a sort of physical crowdsourcing.
Yeah, pretty much.
Yeah, yes. Okay, Rebecca Leventhal, so you're with social finance, right? So tell us a little bit about how that works and how the overlap is with health. Related projects.
Absolutely. So I'm with an organization called Social Finance. We're out of Boston, and we're a nonprofit impact investing firm. And we develop a new instrument called the Social Impact Bond, which is a public-private partnership that raises private investment capital to finance social outcomes. So the idea here is a couple things. One is that typically when the government buys services, they buy services rather than an outcome themselves. So the archetypal example of a social impact bond is actually outside the healthcare space in criminal justice. So we all know that we don't want people going back to prison, right? People are in prison, we want them to be rehabilitated, we want better public safety, we don't want to spend money on their continuing incarceration. But typically when the government were to pay for reentry services, the services somebody might get after they leave prison, they'll do it the way they buy typical things, in a goods and services mentality. So let me buy 400 slots for high-risk men coming out of prison. What they don't do is they don't put their intent front and center. They don't say, I want to buy a lower recidivism rate. I want to buy I only want to buy this if I actually get the outcome I'm intending to achieve. And so what we do is we sign contracts with the government for the social outcome they actually want. A lower reduction, a lower recidivism rate, better outcomes for pediatric asthma patients, a lower teen pregnancy rate. And then we finance that contract with investment capital. So this is not philanthropy, it's not government grant, we're actually connecting it to a new source of investment capital that provides the working capital to scale evidence-based interventions. If the outcome is achieved, the investors receive their money back. But if the outcome is not achieved, the investors stand to lose their capital. So I'll give you an example of one of our first transactions that we launched in December in New York State, and then I'll talk a little bit about health. So in New York State, we partnered with New York State for a reduction in the recidivism rate. The adult offenders in New York State leaving prison, the highest risk, have about a 70% recidivism rate within 3 years. So 70% are returning to prison. And you can imagine the second time you go back to prison or the third time you go back to prison, you're staying for a long time, and it's very costly. We partnered with a really strong nonprofit service provider, the Center for Employment Opportunities, that had 3 things really that made them exceptional. One is that they had a 30-year operational history in New York State, which meant that there was a tremendous amount of administrative data showing how effective they had been, even though it had never been tapped to demonstrate that. Second of all, they used Salesforce.com, which is a client relationship management tool, to track every single encounter that their clients had with the service provider. And so you're able to really query their system to understand what is the dosage that's needed in order to have an effect? Which subgroups are you having the most effect with? And then the third part, which is really well known in the health space, is that they had a randomized controlled trial, which really is the gold standard in social evaluation, that showed just how effective they were at both reducing the recidivism rate as well as increasing employment outcomes for this population. So we signed a contract with New York State to reduce recidivism by a certain percentage. And then we went to Bank of America Merrill Lynch and we put the contract on their wealth management platform and raised $13.5 million from 40+ investors. So really new capital that otherwise would not have entered this space. And as you can imagine, if it's on the Merrill Lynch platform, this is an investment, this is not philanthropy. We're seeing a lot of different applications of this type of instrument, and a lot of them are in the health space. So in asthma, we're looking at pediatric asthma management with outcomes around reduction in ER and hospitalizations, obviously a potential great savings to the government. I'm working on a project in the District of Columbia around teen pregnancy prevention that has both health and educational outcomes. Obviously, young women who are not having pregnancies in children in their adolescent years are having healthier pregnancies, not as likely to incur NICU costs and other acute medical costs, and then also they're much more likely to achieve educational success, which puts them on a track for self-sufficiency, also beneficial to the taxpayers. And finally, we're doing a lot of work around nurse home visiting for Medicaid-eligible first-time moms, which is resulting in outcomes around increased birth spacing as well as better birth weights for the children. And our work, I'll finish on this, is really around bringing together the parties to develop this contract, finding the right nonprofit providers, diligencing them, making sure they have both an intervention but also the capacity to scale, working with the government to do the cost-benefit analysis and make sure that it's a good opportunity for them, and then recruiting the capital to finance the project. And then, and this is a really interesting piece of this that hasn't traditionally been deployed to this extent in social programs, sticking with the investment over the 5 to 7 year period to make course corrections, to manage the project, because even the best, most sort of effective programs were effective when they were evaluated. We don't know what they're like today, and we have to learn and redirect resources, make sure they're being implemented with fidelity or where the learning is. And so we really start with the project at the beginning and then follow it through to execution to make sure that our investors are getting their capital back.
And to be clear, so the reimburser in these cases would be, for example, Medicare or the local government hospital network.
Exactly. So the idea is that the government stands to be the payer of outcomes. Now, what's interesting is that in many of these social areas, and health is one area where a lot of the funding might come from Medicaid, but in fact, in almost any of these areas, our government budgets are so siloed that there are a variety of government budgets that stand to benefit, and that typically they're not incentivized. So think about homeless services. In Massachusetts, the most expensive homeless individual went to the emergency room 72 times in 2011. and he had a renal transplant. All of that was funded by the taxpayers. He's literally the $1 million case. And if he could have permanent supportive housing and evidence-based intervention, expensive, but completely less expensive than cycling through the emergency room and corrections, we could expect to see a significant reduction in his Medicaid expenditure, a significant reduction in his corrections expenditure, and other benefits as well. The problem there is that who is supposed to provide the intervention? It's a HUD-like agency, something like our housing agencies, but who benefits? It's Medicaid, it's Medicare maybe it's the VA, maybe it is corrections. And then you add the complication of the fact that it's not one level of government. So even within Medicaid, in Massachusetts, we have a 50-50 split between state and federal Medicaid. So is Massachusetts just with their 50% incentivized to pay with this? So it's a really interesting way. Is one of the things we found most effective is dealing directly with the budget office in any given jurisdiction, because the budget office can actually pull from each of the budgets in a way that HUD in and of itself would not be incentivized to pay for these outcomes.
Yeah. No, it's really important that you get the benefits that don't always accrue to the same
silo.
Yeah, exactly. But and your social investors would receive back their money plus a fixed rate of interest if they achieve the target?
I mean, these investments are all bespoke at this point, so it's a little hard to draw broad generalities. Some of them have been equity, some of them have been loans. But the idea is that they receive their principal back plus some return should the outcome be achieved.
Okay. Esther Dyson. So ED Ventures, I should say.
Ed Venture.
Ed Venture, excuse me.
Just like
and
Ed
also
Venture.
author of a new book as well. Is that right? You've written something there?
No, that was actually years ago.
Oh, wow.
Whatever. So what I am is the founder of HICCUP, which stands for Health Initiative Coordinating Council. And long story about how that was created, but when I discovered that I would do this, I held 4 brainstormings. And at one of them, this guy showed up and asked all kinds of awkward questions, including how are you going to finance this? As well as what are you going to measure? How do you get community buy-in? The idea is basically 5 communities compete to become radically healthier, throwing off data. The whole point of this is less to help these 5 communities, but more to work with these 5 communities to generate data, models, learnings, analyze the failures, figure out the successes. And this guy has a company called Collective Health. So I hired him to be part-time CEO and ultimately full-time CEO to answer all those questions he had asked. He's also working with you guys he's doing the asthma prevention program in Fresno. So he knows this stuff very well. One of your problems, we were talking about this earlier, is simply a shortage of good opportunities to invest in. It's kind of like, in other markets, well, I want to invest in oils or I want to invest in hot new diagnostic technologies or whatever. There aren't that many nicely packaged programs like this, mostly because and I do this all the time, whenever I hear somebody talk about some kind of health program, I always ask, so what are the outcomes? And often I get, well, we have more children eating healthy lunches every day, or the exercise rate has gone up. But very rarely do you actually hear, we reduced healthcare costs, or we reduced hospital visits, or whatever. So we want to, our first bunch of investors are probably going to have to take most of this on faith, though there are things like asthma prevention and also the whole cycle of hospital discharge, how you keep people healthy after they've been discharged so they don't come back. And as you said, that may often involve not just the hospital, but a visiting nurse, somebody to drive them to get their groceries, whatever. But we want to do these at scale in these 5 small communities and find willing funder/philanthropists, and we would love to give you some business to fund a lot of the things we're doing. Just to go in a little more detail about what's going on, there are restrictions. A government, for example, often cannot contract for more than a year, so it can't contract to give you 50% of the savings 5 years out. That's not allowed. And there's a couple of Congress people who've just launched a bill to change that. There are restrictions around school lunches and what you put into school. I mean, it's not simply, oh, let's go do something. In our case, we're just doing it. But once the communities start to do things where they're spending money and dealing with municipal regulations, it becomes much more complicated. So we're going to be spending 5 years in these communities figuring out how to do this stuff and then how to package it so that someone will invest in it.
And so far, what's your feeling? I mean, you're getting strong uptake?
This started in May a year ago. Rick started helping us in August or something, and though he's still also working in Fresno. We got the word out. We've been going to events like this. I went to School Food Focus on school lunches, and so when we did a call for communities, which required them to fill out a really boring and long 20-page application, get different, the mayor, the school board, the employers, the health system, they needed to come together in some kind of coalition that already existed. It wasn't that we were going to go in and tell people what to do. But if they had a coalition that was already interested in health and wanted to apply, we got 42 applications, which was about twice what we expected. Now we're trying to winnow it down to 5, and here it goes also to your business model question. There was no way we could just tell the other 36, you didn't pass, goodbye, because there's something there. So we have the Way to Wellville, we're going to help them. There's going to be a lot of hand-holding, coaches, whatever. Then there's Greater Wellville, and that's the 36 communities, and that's more an online platform, a community, but it's also going to be in some form a vendor marketplace. So I have a diabetes prevention program. I want to find a place that would like to do diabetes prevention and is willing to provide the surrounding structure, including if you want to prevent diabetes, you have a diabetes prevention program. But if the kids are eating right at school and the local grocery stores are selling healthy food, your diabetes program is going to be more effective. So whether you're an investor who wants to invest in that or a vendor who wants to do one, come to Greater Wellville. There's 36 communities that might be of interest to you, including if you're interested in a particular geography. You're a philanthropist in Montana or something. Well, we've got one for you. And that Hiccup itself is not for profit. My hope is that Greater Wellville will become one of those marketplaces where there's somebody in the middle who collects commissions and manages it. And we will gladly give it away to the person who wants to manage it and turn it into a real business. And then expand it beyond Greater Wellville to Wellville National or something like that.
And there's an interesting sort of common theme, transparency and measurement around this.
Metrics is key.
Yeah, and how? But are there big tensions around that? Just given the culture, perhaps traditionally, of people not being so willing to open up, or funders maybe not wanting to share, embarrassment maybe about whether they can be measured effectively,
or they don't want to not be successful in public.
Absolutely.
And our requirement is whatever you do, we're not publishing individuals' names, but the rest of it is open. So there are a lot of. Everybody knows a lot of health organizations really cling tight to their data, and they use HIPAA as an excuse.
Yeah.
So we're finding, I mean, it's interesting. So we definitely have issues around privacy, particularly in the health space. And we have issues around quality of data, right? I mean, matching systems. This is a unbelievably painful and laborious process to match the foster care system with the Medicaid system, with the school system, and, Social Security numbers are wrong and kids' names are wrong, and it can be quite painful. But we're actually finding an amazing response and interest to the rigor of this from the investor, from government, and from non-for-profit providers. On the provider level, it's almost self-selecting. The people who want to be measured want to be measured. They know that they're doing a good job. They know that they've done the work, and they want to be held to this standard, and they actually want to be held to standards higher than what they've done before. So in our New York State contract, the max return isn't available unless the provider outperforms their existing evidence base, which they actually really liked and wanted. On the government side, it's been really interesting. I mean, the word rigor comes up with such frequency, and we find that it's really an interesting way to find bipartisan appeal. So one of the really exciting things is we're working in New York State and South Carolina, Massachusetts, Oklahoma, California, DC. I mean, it's really kind of across the red, blue, purple divide. And I think part of that is that there is interest in the rigor in terms of are we achieving the social outcomes, and there is interest in the rigor in terms of are we paying for things that we know we got the results for. And that's actually been a really incentivizing aspect for government. So we have not found people shying away from it. And I think to the opposite, we've actually heard governments say that it would just be so beneficial for them as just the externality of itself in the project to know what's working and what's not working and have that start to infuse into other types of their programming as well.
So I have the very fascinating discussion. So I come from a health tech perspective, right? So maybe things are slightly simpler here, but I can see a parallel to what you're saying. So privacy or confidentiality of data, in case of early stage inventors, basically who have something, in many cases, basically confidentiality means we don't want to disclose the technology, right? So therefore, we are not going to tell you how we have come across non-invasive glucose. For 50 years, people have been trying non-invasive glucose, but they're all schmucks. I somehow cracked it, yeah? So that's, and in many cases, the investor and inventor both get a bad deal because they are not, like you said, it's not the rigor, they're not arguing or negotiating or discussing on the basis of actual data. They are discussing essentially on emotion. What if this works? What if it solves the world's biggest problem, diabetes gets solved? And so in a sense, they are fooling themselves. Somehow, if you can crack it can be transparent, and there may be risks to being transparent, but if there are some ways to ensure transparency which hedges some of these risks, then I think that will, to some extent, solve a lot of this investment not being raised at the right stage kind of problem. Mm-hmm. For at least health tech. Maybe I can see that's the parallel with confidentiality, which I could see.
Sure. I wanted to pull back just a little bit and think about different kind of sources of funding. I mean, you would think perhaps there would be some big incentives within the main existing institutions, whether it's hospital systems or it's health insurers. In my own country, the National Health Service, for example, and they do try to carve out innovation budgets, although it very often tends to be deprioritized. There's not the leadership or the championing. Everything else is ring-fenced, so it's the sort of the first thing to get cut. But I mean, how much potential is there, and what do you see as the brakes on innovation within existing payers, as it were, as a primary source of support for new approaches?
There's an interesting comment in, I think, the earlier panel, that the people who are in the system would be the least likely ones to disrupt it. Is it linked to that?
Yes, that sort of thing.
But the Accountable Care Act has actually changed. People focus so much on who's paying, but the real impact, I think, over time is going to be on what they are paying for. And they're now paying for outcomes. I mean, it's a slow and complex transition, but they're paying for prevention. And medical groups are being moved towards being accountable. Accountable means outcome-sensitive care providers. And that, to me, is awesome. Now, people think just dangle an incentive in front of people and they'll change, and that it's not that simple. But it definitely helps, and you've got a new generation of people coming in who are much more used, they use data to count their steps, they count everything. And so why not count what's happening to the patients?
So, I mean, it's interesting. Part of it depends on your definition of innovation, which you and I were having a little bit of interchange on earlier today. I think the government should be investing in innovation, sort of pure research and development, but it obviously can't be the bulk of the government budget, right? And I think this is one place where philanthropy has played an amazing role in the social sector, is it's kind of the ultimate risk capital. Similarly, on the private sector side, VC can be that risk capital if it assesses the risk to be appropriate. But I do think what's interesting here is that we're actually kind of balancing the space between innovation and scaling what works. So, there is a lot of innovation in the programs we're doing, despite the fact that we're scaling an evidence-based practice, because we are learning continually. We're seeing what the data is showing and improving. And so I think that one of the things that actually appeals to government in this is the risk transfer element, right? They're not going to pay if it's not successful, and too often they pay no matter what the outcome is. I really do hope to see more opportunities for government to sort of have an R&D budget, but I also think that it's part of the responsible use of taxpayer money that they should also be deploying funding on evidence-based practices.
Yeah, I mean, we're talking not so much about financing of innovation, but innovation in financing. And financing stuff we know we should do, but we don't because we think short term. It's just like before there were mortgages, only very rich people had houses. And once you created a mortgage market where you had the timing, again, you created a financial instrument that shifted money around over time across different parties. We're talking about doing the same thing here in health, because right now we're paying for health. It's like we're renting health. We're paying for it year by year, and we don't see it as an investment. But the new version is let's buy health, and if we need to take out a mortgage and invest a lot up front to get the benefits over many years, that's what we're doing. But we need a financial market that understands that.
Yeah. And you raised a very good point about this one-year duration very often for contracts with governments. And we talked also about the silo issue and the benefits. I'm wondering if there's any other challenges that you'd highlight that maybe provide a bit of a deterrence for funding for private sector, for example.
Well, again, lack of evidence. And that fundamental question of, it's not always the same people who receive the benefits who pay for them. And that's why we have government taxation in the first. So it's often government flows of funding.
Esther, I have an interesting example there with innovation in funding, right? And also the people who pay for it may not necessarily be the beneficiaries. So my younger brother is an ophthalmologist. He works at a place called Shankara Eye Hospital in South India. So some of you may be familiar with the Arvind Eye Hospital or the Shankara model, right? It is a highly efficient, almost like a factory process for cataract surgeries. So there's a mass screening of people in rural areas. The people who are at risk of that are taken into the first stage of the conveyor belt. Low-skilled staff, so not doctors, but so nurses or just volunteers who are trained the bare minimum, one task. The first step there, that's how you go to the next room where the next step is taken. And in the final room, you have the doctor who just does the only thing which he does, which is the actual surgery. Yeah. So in all of this, what I realized, I was fascinated when I visited his hospital in Coimbatore. They do 70% of the surgeries free of cost, and they still make a profit. It's a profitable hospital, and they do it because they can pull off discriminatory pricing. So 30% who actually pay much more. Yeah, so they have like posh waiting rooms and concierge service and I don't know, caviar. So they can pull this off through an innovative kind of mechanism within their own organization. And I guess so. I'm like wondering whether these kind of things could come up as a mainstream. That it could.
Certainly, there's a lot of that in things that are intangible. I mean, when you're talking about any kind of app. You charge some people or you charge some hospitals, and then you can give it away for free to others. But you mentioned stuff in India. I went to see the Jaipur Foot Clinic, which is an awesome place. It's the original one is in Jaipur. I went to see the one in New Delhi, and I was expecting, a clinic with nice ladies and white coats and doctors, and it looks like a motorcycle repair shop. And they
needs fixing.
Yeah, they take basically the material you make tires out of, and they fit people with artificial limbs. And it's an inspiring place. If you come to the New Delhi train station and you're with a cane or crutches, the taxi drivers will bring you for free to the Jaipur Foot Clinic because they know why you're there. And you will be fitted in a day with a limb that works, and you can walk out. So it's tremendously inspiring. It's funded by donations. But you have to ask, why are all these people coming in with broken limbs? They're falling off trains. They're being run over by cars. And
Yeah.
you know, it's an argument for let's go back one step to prevention.
The holistic, the system level approach was the lowest.
Yeah.
Oh, yeah.
So, I mean, it's interesting when you kind of ask, like, what impediments are we facing? We're not having the challenge of multi-year contracting. We've looked at it in a number of jurisdictions, and some jurisdictions think they can't do multi-year contracts, and by and large, it turns out they have the authority to enter these contracts.
Well, that's good to know.
The challenge we're having, so two things. One is, how do you protect the investors that a future government will pay for it, right? Because there's an appropriations risk around the legislature. Okay, so the appropriations risk. And I think we look at this as saying there's one way to fix it, which is a legislative fix. Massachusetts did this. They created a fund backed by the full faith and credit of the state, and money will flow into it over the life of the project. Obviously, that's great protection for investors. But we're also finding that contracts are vehicles for that. So, you know, typically contracts have standard termination clauses that governments use every time they purchase something. Governments also typically take the performance risk when they purchase something. And so if they were to terminate unilaterally, they wouldn't they would have already had the goods delivered and taken the risk. Here, they're not paying until an outcome is achieved, which has to be evaluated by a methodology. And so they could terminate the day before an evaluation is about to be had. So one of the things that we've been doing to deal with the appropriations risk is how do you think about termination clauses appropriately so that investors could be compensated in the event that a government decides to terminate the day before evaluation. The other real challenge we're having, and it's a learning process and has been really interesting, is that government isn't used to buying outcomes. Government is used to buying goods and services. And so there's just been a real orientation shift. And I think one of the things that's been really interesting is that our whole procurement system here in the US has been developed around goods and services. It's been developed around the government being extraordinarily prescriptive about what they want to buy, how they want to buy it, what exactly it's going to look like. When you're buying outcomes and you're only paying if the performance you want is achieved, you have to transfer discretion as well, because nobody's going to say, yeah, I'll give you those I'll get paid only if you achieve the outcomes, and I'll follow the exact strategy the government tells me to use, right? So that's a place where we're seeing challenges, a lot of new, interesting innovation, and a lot of governments thinking about what this means. But I think that's been one of the challenges we faced early on, is government just having to shift their mind into a totally new type of purchasing that they've never participated in before.
So before we open it up, just a word on the more kind of social end, the philanthropic end of funding. I mean, it sounds like a lot of your business entrepreneurs are quite, you know, they're fairly bottom line about this, as you say. They don't want to invest too much in the high risk innovation, but more things that are proven.
Application oriented.
Yes, I mean your bonds. I mean, there are some people who want some reasonable return, but on the other hand, there's a kind of social motive as well. Do you see a growth in appetite by high net worths, for example, who want to do this sort of thing, and they want to do it in the health space in particular?
Yeah, absolutely. So it is definitely, it's part of this impact investing movement, investing for social and financial return. So there is definitely a social lens where people are investing, but they want their money back and they want a return. And we're seeing kind of really four main reasons I think that people participate in this type of investment. One, to your point, is that they're attracted to the social issue area. I care really about asthma. I care really about family planning. Another is geography. A lot of people want to invest in a place, maybe the place they're from. We're seeing this kind of catch-all, which is kind of two or one. One is a new way of deploying capital in the social sector, so kind of a new type of philanthropy. And the other part, and I'd say the number one sort of word, if you ask probably investors in our New York State transaction to self-identify, I think they probably all call themselves a pioneer. And I think we found that this idea of being a pioneer on a new movement, you know, I'd love if it's the new mortgage market. That might be overly ambitious. Maybe the new microfinance, that would be just fine. But the idea of being part of something new. And I think, you know, one thing that's so interesting is that we're trying to find these outcomes that align really diverse incentives. And, you know, if you think about social issue areas that high net worth individuals in the US care about, criminal justice outcomes are not top of people's lists. These are kind of, you know, the kind of least appealing members of our society. And people were interested in investing in that. We see a tremendous amount of interest in the healthcare space on a range of different issue areas, and, you know, a much lighter lift to get there because of the sort of natural empathy people have for health issues.
Yeah. your experience as well, Esther, when you've been talking to potential backers?
Yeah, I mean, we're just at the beginning, but definitely nobody, you're certainly invited to, but people aren't as interested in funding two white people in New York and Hartford. They're interested in funding something in Garden City. They're interested in funding a particular project in Garden City, something that's meaningful that involves people and where they can, you know, if you're not going to get a hospital wing, at least you can get a photo op or something.
Yeah, any more thoughts? I mean, there is obviously some philanthropic activity in India as well that might
yes,
be
of course. So I think that's growing, and especially the impact investment. I'm quite fascinated by how GEARS or other measurement frameworks could essentially do like what GAP has done for accounting. So would love to hear your thoughts on that as well. What's the way to measure? The transparency bit applies to impact investment as well, right? So when it comes to actually philanthropy in India, it's an interesting question because I don't think Indians have traditionally been that generous at all. Yeah? So none of these, I mean, most of the donations for many of these high impact projects in health come from the US, from Europe, and not even from expats, not even from NRIs, not even from Indians who live there, but from other people, right? So what's, I think, mostly been happening traditionally in India is that the rich families who own big businesses, they would fund religious causes, temples and so forth, right? Now I think, luckily, three things have changed which are slowly bucking the trend. One is the young people, the second or third generations of these families educated in the US are now in charge. Slowly it's changing, right? And secondly, they're also, the impact investment bit is suddenly also getting a little bit of more, people are thinking about it a little bit more. So, and many people are getting convinced in that. And the third thing is generally the whole India shining thing, They believe that if they put their money here, it's not going to drain down a black hole. It's going to lead to something bigger. And that sort of hope is there. So I think it's changing. The philanthropic kind of, or impact investment bit is really changing quite quickly over the last 10 years.
Sure. Okay. Anyone in the audience like to, there's one here, please, yeah.
Kurt Malkoff, and I'm a clinical psychologist, and I find all this fascinating, by the way. It's very refreshing to hear people break glass and shift paradigms and whatever. At any rate, over almost 40 years, I've learned that it's almost impossible to predict human behavior. I can tell you why something happened after it happened, though. With that said, so I've got a bunch of money to invest in one of your projects. And I think, Esther, you were an analyst or a securities person at one point. If I'm buying a bond from you or Bill Gross or whoever, it's rated and I know my risk exposure. Do you lay out, say, 5 projects and say, okay, the chance of this succeeding is 80%, but your return is 14. The chance of it succeeding is 90%, but the return is 12. Is it metric like that, or is it just sort of thrown against a wall, and if I like it and it resonates, I go with it?
Rebecca, you answer first, and then I'll answer.
Yeah. So that's a really interesting question, because I think you're asking, you're charting 2 parts of data, right, and evaluation. One is, did we get the outcome we wanted? And the other part is, why did we get the outcome we wanted, right?
Good with the statistics, you'll always get the outcome you want.
But the question of why, right? And so one of the things when I talked about this program in New York State around prison recidivism, it wasn't just that they had the randomized control trial that said they reduced recidivism by X%, but they had all that programmatic data. We were then able to link to files and understand, who was performing and why were they performing and what were the key indicators that suggested whether or not they performed. That sort of internal process data is really important for the types of investments we do, because it allows us to say, we actually think we have refined the model better than what the randomized control trial provided for. And so we have expectation of how likely we are to reach the metric, how likely we are to outperform the threshold, et cetera. And so accordingly, we were able to provide to our investors a great deal of detail about how likely we thought they were able to get their money back in a real expected value. So this is really a data-driven exercise. It is not anecdotal or theoretical.
Yeah, and as Rebecca says, it's, at least now, most of these are bespoke. So if you came to us we would tell you, you know, this is this kind of program. It's had such and such a success rate. This is this kind of community. I mean, we're going to learn a lot. Some investors like to visit the stores of a retail chain if they're going to invest in the retail chain. If you're from Kansas, you might want to go check out Garden City and talk to the people running it, because it is your hospital wing. This is a project you want to fund. It's your bequest.
It sounds like monetary return isn't the primary mover on it.
You know, we hope that later it will be, honestly, but at least in our case, I think, you know, we're actually selling something more interesting than just 12%. 12% is pretty good, but you know, the risk is reasonably high too. I think it's going to be a big market, and I think there will be different approaches. You know, there's Moody's ratings, but that's years and years of experience, and then it turned out they weren't right anyway. So it's something where it's new, and so people inherently think they're taking a much bigger risk than they are.
I also would say, I mean, if you think you're doing this for profit alone, this is not the instrument for you, right? And this really is part of this impact investing movement where people are thinking about social return and financial return. I think, you know, when Bank of America Merrill Lynch did a survey of all of its wealth management clients, which you can imagine there are tens of thousands of them, they found that over 50% wanted to invest along social purpose as well as financial purpose. And then when they started to break down that data, they saw that as you move towards the millennials, you saw a higher percentage wanting to invest along social purpose, which means for Bank of America to kind of continue to play a leading role in the wealth management space as the new generation comes of age, they need to be offering these types of products. So it's interesting, right? Because on one hand, it's a really good move for Bank of America to start kind of offering these interesting products that might help them, you know, do better than a competitor bank. But the other piece is it is a social. You're not doing it just for profit, right? But it is an investment. And you know, some of our investors, you know, have sort of spoken on the record about their investment. It's folks like Larry Summers. I can tell you he looked at it with rigor, but it's with a social lens as well.
But I mean, at the same time, in the old days, when you got a mortgage, you mortgaged a particular building, and someone probably came and inspected it, and then we went way too far towards derivatives and mortgage portfolios, and you know, stripping them into different asset classes and so forth. And I'm sure that will happen in the future too. I just hope we manage the risk better.
Okay, there's a question behind you.
Yeah, so I work in healthcare innovation, and so it was a great segue from what you all were talking about before. We're smack dab in the middle of the paradigm shift between being strictly quantitative and economics-based to qualitative and quantitative. And I'd like to talk, or I'd like you to speak specifically to your open innovation platform and what that may have helped or how that's benefited you in any way in improving those models and pushing forward.
So I think it's still pretty early days, right? I mean, just a quick count. How many of you have bought anything from Kickstarter? There you go. So it's not mainstream. And this is, I think, the kind of crowd who would buy from Kickstarter, right? So, yeah, so it's very, very early stage, a lot to prove, but my optimism and hope stems from, in the last 10 years, everything has completely changed, many industries, right? And it's technology, it's connectivity, it's about individuals being able to impact their world in a bigger way. So I think it's ripe for disruption, our current funding model. I'll tell you maybe a little story there. So I'm a visiting faculty professor at my alma mater, a business school in India called Indian Institute of Management, Calcutta. Right? So I run a course there called Social Entrepreneurship. One of the modules is how to raise funding. Yeah? So there I also get other guest faculty from Sequoia and VC funds, you know, as well as impact investment funds. So I think what's generally happening is that all of these are sort of acknowledging the shift which is happening. So I think especially the VC funds you mentioned, the due diligence process, it just doesn't work for early stage ideas. The innovations which we are talking about, which are so disruptive that a discounted cash flow model is going to lead to garbage in, garbage out. Yeah, you don't know what's the valuation, what's the impact. You can apply whatever framework, however good, but it's not going to lead anywhere. What open innovation, things like Kickstarter, but maybe variants of that in the future, will enable is almost a real-time data of the potential impact of that idea, right? And in health, I don't think there are a few successes. I mean, if you look at Indiegogo and a few other crowdfunding platforms, there are a few successes. But there are, I think, still flashes in the pan. There are like exceptions. If we can arrive at the right kind of system, processes, which will systematically take huge amounts of good ideas, huge amount of creativity, a lot of people, and sort of put them in this almost like a idea factory, we will come to, I think, probably a completely different way to fund disruptive healthcare ideas. That's what that said, it's all, like I said, early stage. I'm going to fail 120 times before I get anywhere. Yeah.
So hello. Were there any specific measurements that you used when deciding on the open innovation platform, or the advantages of going through that?
Sure. So I'm sort of, my team is sort of feeling its way through right now. I'll give you an example. There was a designer from Bangalore who had a great idea for a smartphone for the blind. Right now, blind people can take calls and switch off calls, but nothing much else. They can't access email or Facebook reliably, as far as I can see, in the mainstream visually impaired kind of community. So he had an idea. He had an idea, basically. He believed in the idea. What we had in this physical crowdsourcing kind of session, collaboration session, was that he accidentally bumped into 3 software developers and a hardware maker kind of guy from Pune. He's from Bangalore. He just happened to bump into them in this session. And they sort of brainstormed their way from Sumit's original idea. I call it, I was like, I did know nothing in the project, but my only contribution was this, this useless piece of advice, call it the iPhone. Anyway, so eventually this kind of, very qualitative, it was not metric driven at this stage, very early stage. These are the 3 potential kind of prototypes. This could happen. Then they talked to Google, they talked to people from the Android team. Can we make it a part of the Android system? So these kind of it's very qualitative. But the moment I think numbers start entering the picture is, say on Kickstarter, if you've seen how the platform works, that once a bare bones demonstrable kind of prototype has been generated, then how much interest is there in consumers? Right? And this is suddenly now it's becoming real-time feedback from your potential buyers. It's working so far sort of for consumer technology, things I need for my own house and my own, small iPhone cases and whatnot, But if it works in health tech or not, I would need consumers of health tech, clinics, physicians, maybe if it's POC or something, I don't know. So is there a system which could address that numbers gap? This is something which I'm working on. So we have some hospitals and clinics on board of this platform. We'll do a little experiment to see if internal kind of process for generating this data is possible or not.
Okay, who else? Is there another question? Oh, sorry, yeah, please.
I'm very interested to hear more about buying outcomes. When we first launched our company, we went out with that model to healthcare systems and got exactly the same response. We buy goods and services. We wanted to take their low-performing readmissions, if they were getting readmissions in CHF and they were getting readmissions in diabetes, give us those patients and we'll split the benefit with you at the end of a predetermined period of time. And what you end up finding out is that they own a piece of their post-acute partners. They own some of those skilled nursing facilities, and those are some of the worst performing facilities for those kinds of patients. So how do you untangle that web with those partners?
Accountable Care Act. I mean, you need to make them responsible for outcomes, and then they'll start buying outcomes. As long as they get paid for care, yeah, they're incentivized to provide more care.
So I think Esther's point resonates a lot with the way we think about it. So the type of financing we're doing doesn't work for everything. It works for the type of outcomes that government actually wants to purchase, or a corporate payer, or a insurance company. So there are many outcomes that we might decide are socially valuable, but government might not have an incentive to pay for it. Now, it could be a savings savings could be the basis, but I also think that there's an argument for government to pay for educational outcomes, because they're paying a lot for education, they're just not getting good outcomes. But savings could be the basis of that. We see a lot of interesting work around even things like how close a family, how well knit a family is, right? That could be a good social outcome, but not easily monetizable for government, whereas involvement in the foster care system, very, very easily monetizable for government. So I'd say part of it is whether or not it's something that that entity wants to purchase.
So better success going right to CMS and saying, look, you're losing $14 billion a year on CHF readmissions. Let's talk about collaborating on that.
It may be. I mean, I think if you're thinking about who ultimately stands to pay for that failure.
Okay, any other questions? Can I see any more?
I think they want the wine tasting.
Oh, it's the wine tasting. Okay, well, thank you for the questions. Thank you, panel. Great conversation.
Thank you.